Today, I would like to analyze Uber, one of the largest ride-sharing companies in the world. When we take a look at the stock price, we had an incredible performance in the last years. We are up close to 280%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 173.17 billion US dollar. This makes Uber the largest ride-sharing company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2020, the revenue was around 11 billion US dollar. This was a 14% decline from 2019, so related to COVID. Then we had a strong comeback with a growth around 56% in 2021. In 2022, we had the incredible growth around 82%. Then in 2023, we had the growth around 17%. Which is also very good. And in 2024, we had a strong growth around 18%. So we have a check here. We had a good revenue growth in the last 5 years. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 3.3 billion US dollar in the negative. Then in 2021, we had a better result with a negative free cash flow around 0.7 billion US dollar. And finally, in 2022, we had a positive free cash flow around 0.4 billion. In 2022, we had a strong growth around 762%. Then in 2024, we had a strong growth again around 105%. So it's also a check here in the free cash flow growth. This is something we like to see. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we want to see a high free cash flow yield. We're going to take the free cash flow from 2024. So this is around 6.9 billion US dollar. We're going to divide it with the current market cap, 173.7 billion. So then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 3.98%. So I think this is a decent free cash flow yield actually for a technology company. And also probably we expect in the free cash flow to grow in the future as well. So it's not a check here, but we're also going to take a look at the future free cash flow as well. If we ask ChatGPT for future assumptions of the free cash flow, we can see here in 2025 the free cash flow could be around 8.4 billion US dollar, in 2026 around 9.9 billion US dollar, in 2027 around 12 billion US dollar. So let's assume for 2027 we can reach around 12 billion US dollar. So then we're going to divide it with the current market cap, 173.17. So then we're going to get the free cash flow yield for 2027 with our assumptions. So the number we're going to get would be around 6.92%. And this is actually a very high free cash flow yield, so it would be over 4%. And this is something we like to see. It could be an indication for undervaluation. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years, a very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 8.35 billion US dollar. Then we're also going to take a look at the short-term debt. We can see here around 1.15 billion US dollar. We're going to divide it with the current free cash flow, around 6.9 billion. So then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 1.37. This is a great number actually. It means a little bit over 1 year we can repay the debt with the free cash flow. So is a check here. We like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around, so in 2024, around 7 billion US dollar. So this is also a great amount, and I think this company has a great balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. The current market cap, 173.17 billion. We're going to add the debt. So the debt is around 9.9 50 billion. Going to take minus the cash. So this was around 7 billion. So then we're going to get the enterprise valuation for 2024. So this is how much the whole company is worth. So now we're going to get would be around 175.67 billion. This number we're going to divide with the current free cash flow. So this was around 6.9 billion. So then we're going to get the ratios that we're looking for. So the number we're going to get would be around 25.45. So I think this is a great number for a technology company. Of course, it's over 25, so it would not be a check here. But we can also calculate this number for 2027 with the free cash flow assumptions of 12 billion. So let me know in the comment section if you think this assumptions is realistic. Then we would get around 14.63. And this is a great number actually. This is definitely an indication for undervaluation, but only if these assumptions are realistic. So let me know in the comment section, what do you think? The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. So we like to see that, especially we think the company is undervalued. So we're going to take a look and we can see here repurchase of common stocks. So yes, this company buys back their own shares around 1.25 billion US dollar in 2024. But if we take a look here, we can see stock-based compensation. This was around 1.8 billion US dollar in 2024. So what does it mean? This company pays the employee with stocks. So actually the shares outstanding increased over the years because the company pays the employee with the shares. So it's not a check here. Can Uber stock be a good buy right now? So let's start with a positive. So we had a great revenue growth in the last 5 years. We also had a great free cash flow growth as well. This is something we really like to see. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. The free cash yield around 3.98% is also looking decent for a technology company. And with our free cash flow assumptions for 2027, the free cash flow yield would be around 6.92%, which would be an indication for undervaluation. Our enterprise valuation to free cash flow ratio around 25.45 is also looking decent for a technology company. And again, with our free cash flow assumptions for 2027, it would be around 14.68, which would be an indication for undervaluation. What I don't really like to see is the shares outstanding increase. So the main reason for that is the stock-based compensation. So they pay the employee with the shares. This was around 1.8 billion US dollar in 2024. So overall, I still think this company can be a good buy right now, but only if the assumptions for 2027 are realistic. If you found this video helpful, don't forget to like and comment and subscribe for more content.